The stock market made 1,000 new millionaires this week. Not hedge fund managers, not Wall Street insiders, just regular people who learned one thing everyone else was too intimidated to figure out. Let me ask you something. Where is your money sitting right now? If it's in a savings account, you are probably earning somewhere around 1 to 2% interest annually. Meanwhile, the stock market has historically returned an average of about 10% per year over the long term. That gap is not just a number. Over decades, that gap is the difference between barely getting by in retirement and living comfortably with money to spare. So let's get into it. A stock is simply a small piece of ownership in a company. When a company wants to raise money to grow, instead of only borrowing from banks, they can sell tiny slices of the business to the public. Each slice is called a share. When you buy a share, you become a part owner of that company. Small, yes, but an owner nonetheless. If the company grows and becomes more valuable, your share grows in value too. That is the fundamental engine of wealth creation in the stock market. Now, here is where people get confused. The stock price moves every single day, sometimes every second, and that movement can feel terrifying when prices drop. But here is the psychology trap most beginners fall into. They see prices falling, panic, and sell. Then prices recover, and they missed the comeback entirely. The people who get rich in stocks are almost never the ones trying to predict every up and down movement. They are the ones who stay patient and think in years, not days. There are two main ways you can make money from stocks. The first is capital appreciation. This means your stock goes up in value and you eventually sell it for more than you paid. Simple enough. The second way is dividends. Some companies share a portion of their profits directly with shareholders on a regular basis. This creates a stream of passive income just for holding the stock. Imagine getting paid simply because you own a piece of a business. That is one of the most powerful concepts in personal finance. Now, you might be wondering where to actually start. The honest answer is that most beginners should not try to pick individual stocks right away. The smarter move is to invest in index funds. An index fund is a collection of many stocks bundled together. For example, an S&P 500 index fund holds shares in 500 of the largest American companies at once. So instead of betting everything on one company, your money is spread across hundreds of companies. This dramatically reduces your risk and still gives you exposure to overall market growth. The secret weapon that nobody talks about enough is compound interest. When your investments earn returns, those returns start earning their own returns. Over time, this creates an explosive snowball effect. Starting early matters enormously here. Someone who invests consistently starting at 25 will typically end up with significantly more wealth than someone who starts at 35, even if the later starter contributes more money overall. Time in the market genuinely matters more than timing the market. Let me give you a framework for getting started. First, open a brokerage account. Platforms today make this incredibly easy and often charge zero commissions. Second, start contributing whatever you can consistently, even if it is just a small amount each month. Third, invest primarily in low-cost index funds to start building your foundation. Fourth, keep adding and resist the urge to panic sell when markets dip. Drops are normal. They are actually buying opportunities if you have a long time horizon. One more thing that separates wealthy investors from struggling ones is emotional discipline. The market will crash at some point. It always has, and it always will. The investors who came out ahead through every historical crash were the ones who held steady or even bought more during those scary moments. Your ability to stay calm when everyone else is panicking is genuinely worth more than any fancy strategy. Here is your takeaway. You do not need to be a financial genius. You do not need a huge starting balance. You need consistency, patience, and a basic understanding of how stocks work. The information you just heard is more than enough to get you moving in the right direction. The wealthy are not smarter than you. They simply started and stayed the course. The best time to begin was years ago. The second best time is right now. Go open that account and take your first step toward the life you actually want.